Hello and welcome to the Hodge & Law PC International Tax Lunch for September 30, 2022. I'm Phil Hodgen. Welcome to the show. We broadcast this once a month on Friday at noon Pacific time through CalCPA, thanks to them. And if you're listening now, you're listening through the courtesy of the CalCPA link. We also post these things later on YouTube, so you can watch them later to your heart's content. This month's topic is all about the attribution rules as applied to Form 5471. So these will be rules that cause you, even though your name is not on the stock certificate, to be treated as if you are a shareholder in a foreign corporation, an indirect shareholder, or a constructive shareholder. And we'll talk about the meaning of those words and then how to apply the concepts for categories 1 through 5, the 5 different filing categories for Form 5471. Let's get two big ideas out of the way. And the first one is just to highlight the fact that there are 3 different attribution rule sets in play for Form 5471. For categories 2 and 3, these are transactions by which U.S. persons acquire or dispose of enough stock to trigger a filing threshold and therefore file Form 5471. The attribution rules are found in Section 6046. And specifically, that's where the reporting requirement is laid out. So you have to file a piece of paper, says Congress, and built into that are a specific set of attribution rules for what does it mean to be an indirect shareholder and what does it mean to be a constructive shareholder in a foreign corporation. Or for those 2 categories, what does it mean to indirectly acquire stock or constructively acquire or dispose of stock. Category 4, the filing requirement itself is found in Section 6038A, and in that code section, the code tells you use the default attribution rules at Section 318A, and there are a couple of modifications that you have to apply. For categories 1 and 5, the rules are the same. There's no explicit part of the code that says do this, and there's nothing in the code that spawns Category 1 and Category 5. Category 1 is our friend since the end of 2017 when Section 965 came into play. Section 965 talks all about how to calculate the tax, the transition tax that came in at that point, but it doesn't say anything about reporting requirements. Similarly, there's nothing in the code that you can directly attribute the Category 5 reporting requirements to. Instead, in 6038A4, there's a generic thing that Congress often does. It says, hey, Treasury and IRS, if you need to ask for information from a taxpayer in order to make the whole system work, go for it. So that go for it authority is why we have categories 1 and 5. And in the go for it category, we now have to look at Section 958A and 958B, which tell us about indirect and constructive shareholders. And again, there's some modifications to Section 318A in Section 958 that will apply for categories 1 and 5. So there are 3 different ways that you have to look at the attribution rules. They are not identical. There's sometimes when you do have attribution of ownership from a non-resident alien family member. There are other instances where you do not, so you have to be careful. So the point here is to keep in mind that there are different attribution rules, and just because you know something off the top of your head doesn't mean you really know it. So read the regulations and read the instructions to Form 5471. The second one that I just want to highlight here, it's a grammar thing. When we talk about direct stock ownership, indirect stock ownership, constructive stock ownership, we're talking about an adjective: direct shareholder, indirect shareholder, constructive shareholder, shareholder being the noun. And attribute or attribution is the verb. So the way by which we cause somebody else to be treated as if make pretend they are an actual shareholder is by attribution. So as you go through this, keep in mind what is happening. If you are looking through a stack of entities, you're talking about indirect ownership. If you are talking about ownership by way of a human being in a family relationship, you're talking about constructive ownership. And having said that, if you read the code and the regs, you'll quite often find that these adjectives are not used with enough care and precision. And so you'll have to say, no, they really meant indirect when they actually use the word constructive. And then there's this final thing in bright purple down at the bottom, where quite often in the code or the regs you'll find the phrase actual shareholder. And really what it's just doing is saying, we've for some reason decided that you are a shareholder because your dad is a shareholder, and therefore you are a constructive owner of your dad's stock, but we're going to treat you as a actual for real shareholder for purposes of further attribution or other purposes. So just watch out for the word actual. I think what they're trying to do is something that says it's tantamount to direct ownership, but not quite. So you'll find a lot of sloppy verbiage here, so just be warned. My suggestion is that you keep it straight in your head as much as possible, because clear thinking will help you come to the correct answer. And here's a little picture just to help you understand what I mean. And if you look at the traditional parent substructure on the left with blue stick figure at the top, the idea of your name on the shareholder of the stock certificate for Parent Limited, you're a direct shareholder because you are the real shareholder on the share registry. Indirect ownership is through this chain of ownership of you own stock in parent company owns stock of subsidiary. Therefore, you have an indirect ownership interest in subsidiary. And the easiest sort of real-world way to look at this is to think of this as you have an economic ownership interest in subsidiary limited by way of your stock ownership in parent. So think in terms of indirect meaning an economic interest. By contrast, if you look over to the right, where you got dear old dad who owns 100% of Father Co. Limited stock, you are treated as the constructive owner of that stock because of the family relationship, parent-child in this situation. You don't have an economic interest per se, because you will not have any economic interest unless dad gives you the stock or you inherit the stock, because the economic reality of that corporation, Father Co. Limited, is that if it makes a distribution, it must make a distribution to the shareholder, namely dad, or if it's dissolved and it pays off all its debts and then whatever assets are left over will be distributed to the shareholder, again, dad. So the only person who can really take any economic value out of the corporation is dad. So this is a non-economic interest. And as you're going through this thing, if you keep in mind this thing being our chat for the next hour or so about attribution rules, keep in mind that constructive ownership is a non-economic relationship between you and this other foreign corporation. So economic ownership, indirect. Non-economic interest is the constructive ownership. Now, let's launch into the 5 categories. And category 1, this is the transition tax from the end of 2017, Section 965. The rules that we use, attribution rules, to determine are you an indirect owner, are you a constructive owner of stock in a foreign corporation, are identical to the Category 5 rules, so I'm going to deal with all of them then when we deal with Category 5. Let's launch then into Categories 2 and 3. This is not really part of the discussion here. We're talking about what does it mean to be an indirect shareholder, what does it mean to be a constructive shareholder. But just for context and clarity, I want to talk a second about who files for Category 2 and Category 3 on the Form 5471 and what triggers the filing requirement. So first, the who files. Category 2 is aimed at U.S. persons who are officers or directors of a foreign corporation. And when anybody comes along who's a U.S. person and acquires enough stock in that foreign corporation, that U.S. shareholder, that U.S. person who is the officer or director must report to the IRS that someone else, who is also a U.S. taxpayer, had acquired enough stock to trigger the threshold reporting requirement. And it's a 10% trigger. At the 10% point, you're going to have to report that person X acquired some stock. So in other words, anybody who is a U.S. person and is an officer or director of a foreign corporation has an obligation under the Internal Revenue Code to rat out other taxpayers. Category 3 is when you report on yourself, to raise your hand and tell the Internal Revenue Service that you acquired enough stock in a foreign corporation or you disposed of enough stock of a foreign corporation to hit the triggering thresholds. There's another category. If you go from non-resident alien to resident alien, you suddenly become a Category 3 reporter for the year of transition from non-resident status to resident. But here again, the key thing to take away from this is there's a trigger that you acquired or disposed of enough stock, and again, it's a 10% threshold that you have to report for yourself, and it's just a one-time thing. It doesn't carry any tax liability. It doesn't make an income inclusion or anything like that. It's just a reporting function. So how do you acquire or dispose of shares? Well, there are 3 ways, one of which is you direct ownership, so your name is on the stock certificate. We're not going to talk about that today, but what we are going to talk about is how do you acquire indirect ownership in a foreign corporation for purposes of Category 2 and 3, and we are going to talk about constructive ownership. How do you acquire constructive ownership of stock of a foreign corporation when a family member acquires or disposes of stock of that foreign corporation? Not you, but a family member, and the right family member. So let's start with the weirder one first, the family attribution rules. And again, we're talking about creating constructive ownership of stock. You don't have an economic interest in the company, but for reasons known to Congress, they've decided it's important for the government to know that this shareholding relationship exists within your semi-nuclear family. And here is, out of the regs, I mean, the code says largely the same thing, but I've just pulled the regs out for you. It says, here are the family members that you are treated as if they own the stock, you own the stock. If they dispose of the stock, you've disposed of the stock. If they acquire the stock, you've acquired the stock for purposes of Section 6046 and Categories 2 and 3. And it's up and down the bloodline, up to ancestors as far back as you can reach until you find that everybody's dead, and downstream to your lineal descendants until there's nobody born yet. But in theory, infinity in both directions. And sideways for siblings and sideways for spouse. And one important thing to note here, because it's always going to come into play in my experience in foreign, not always, but quite often, is attribution from non-residents. Is it or is it not permitted? And in the context of Categories 2 and 3, attribution of ownership of foreign corporation stock from non-resident family members is allowed. And this is by contrast to Categories 1 and 5, where attribution from non-resident alien individuals is not allowed. So you can be the constructive owner of shares owned by a family member for Categories 2 and 3 purposes, even though the family member is a non-resident. Here's my little pretty picture that shows you the attribution for constructive ownership of stock by you, blue stick figure in the middle. So you can see if any one of these people owns shares of a foreign corporation, you are treated as if you own those shares for purposes of categories 2 and 3. So you can see here you've got sibling. What happens, for instance, because I've seen this, if you have a brother that you have not talked to for 25 years and you are estranged from that person and you no longer really even know specifically how to get in touch with brother because your relationship is that bad. Well, if brother spins up a new foreign corporation, technically you have acquired the stock of that corporation, but how are you going to satisfy your Category 2, Category 3 filing requirements? Interesting point. Nevertheless, this is what you've got to look forward to, and Category 2 and Category 3 is going to be the one that's important for you to watch for. There's no family reattribution, so when you take someone who is the direct shareholder, their name is on the stock certificate, and you treat another family member as the constructive owner of that stock. So that's the first bounce. There's not going to be a second bounce from the constructive owner to another person to make that other person a constructive owner too. Here's a little example that shows you a situation where you have a child, blue stick figure. You have dad, who is a 25% direct shareholder of a foreign corporation. Dad's brother, namely uncle, is also a 25% direct shareholder of the foreign corporation, and some unrelated person owns the other 50%. So how does this work out for child, blue stick figure, and for father? You can cut to the chase. You can see the numbers in the black circles below that we're going to treat child as a 25% shareholder of foreign corporation, constructive ownership, and we're going to treat dad as a 50% shareholder of foreign corporation, 25% directly, and 25% by constructive ownership, by attribution from sibling. So look at the top long green arrow. So we have dad's shares are attributed to child because of the attribution rules explicitly called out in section 6046. Parent-child, that's an attribution rule, so child constructively owns father's 25% directly owned stock. And then look at the pair of arrows, the green one pointing to the red one, and now let's talk about how shares owned by uncle are attributed to father but are not reattributed to child. So from the person labeled uncle, who is father's brother, there's going to be the sibling attribution. So father is treated as the constructive ownership of his brother's stock. So that's why father has 50%. He has his own 25% directly owned and 25% constructively owned by way of uncle, his brother. But when we do the second bounce of the constructively owned stock, uncle's stock to nephew, the child, we do not do that the second bounce, and therefore we do not end up with a situation where the child has 50%. The child only has the 25% from the single bounce from dad to child. Now finally, this again is off course, but I think it's important enough because I've seen it enough that it may happen to you if it hasn't happened already. You have a situation where you have a marriage between a U.S. person, green card holder or a U.S. citizen, and the spouse is a non-resident alien. And here's a situation where you can accidentally have an acquisition or disposition of stock that may need to be reported for Category 2 or Category 3 purposes. So my little example here is a couple that is married. One is a U.S. citizen, let's say the other one is non-resident alien, and they've gotten enough tax knowledge in their heads to understand that if the U.S. citizen spouse has any contact with a foreign corporation, it's going to spawn Form 5471 and a great deal of pain and expense. So they don't want to do that. So non-resident alien spouse spins up a new corporation, makes a capital contribution, and acquires 100% of the stock of the foreign corporation. The non-resident alien spouse is very careful not to appoint the U.S. citizen spouse as an officer or director of the foreign corporation, and U.S. citizen spouse is happy about that. And so we know for certain that U.S. citizen spouse can never be a Category 2 filer because U.S. citizen spouse is never an officer or director. So that's good. But U.S. citizen spouse is a Category 3 filer for the year in which this corporation is formed, because if you want to think about it this way, at one moment no corporation existed and the non-resident alien spouse owned nothing, and the next moment the non-resident alien spouse owned 100% of the stock of the foreign corporation. So there was an acquisition of stock there. And what this means is anytime you have a non-resident alien spouse that forms a corporation, dissolves a corporation, or there's stock changes that are large enough to trigger the disposition rules for Category 3, you've got a Category 3 filing requirement for the U.S. citizen spouse, even though the U.S. citizen spouse has no economic interest in the foreign corporation. The other thing you have to watch out for, and this happens more frequently than you'd care to admit to yourself, is that there are a lot of countries in the world that have community property laws of one kind or another. Some of them are quite close in concept and application to the California community property rules. Some are wildly different, yet they are community property rules, and they give a the spouse that's not on the name of the stock certificate nevertheless has a 50% economic interest in the stock. So you have to watch out for accidentally creating a 50% shareholder if the person lives in a community property country. Anyway, this is a common thing. The other thing that happens is if there's a spouse, a U.S. citizen, that gets married to a non-resident alien that already owns a foreign corporation, that's an acquisition too. Anyway, a little practical warning there. Watch out for these. Categories 2 and 3, we've talked about constructive ownership. Again, that's from family members to you. Let's talk now about indirect ownership through entities. And this is, how do you deal with the classic parent-sub kind of relationship, and how do you calculate your share ownership and whether you have acquired or disposed of stock sufficiently to create a Category 2 or a Category 3 filing requirement. So you're going to see when we come to Category 4 and Category 5 that there are some floor and floodgate rules. And I don't know if those, I don't know, that's what I call them. And the floor rule is kind of like a threshold. Say below X percent of stock ownership, don't attribute any ownership of a stock to yourself. So if you're a tiny shareholder, we don't care about it. So you'll see in Category 4 and 5, there's a 10% threshold. And on the other hand, above Y percent, whatever that Y happens to be, we're going to treat you as if you own or you control the entire company. So for Section 6046, the acquisition and disposition for Category 2 and 3, we don't have those floor and floodgate rules. It's strictly a proportionate calculation. The other interesting thing about Categories 2 and 3 as compared to Categories 4 and 5 and 1 are that the attribution rules make indirect stock ownership only for two types of entities: foreign corporations and foreign partnerships. And the rule is simply you just do the proportional, you do the math, and you own indirectly the stock of the lower tier corporation, according to your ownership of the upper tier entity. Here's a couple of examples: a corporate structure on the left, partnership structure on the right. The concepts are the same. I've got the same numbers in the examples both times, and you'll see that the math, is the same both times. You've owned 40% of parent company on the left. Parent company owns 80% of subsidiary, foreign corporation 2. 40% times 80% equals 32%. And so that is your ownership interest in the foreign corporation. So in the year that parent company, Foreign Corporation 1, spun up and acquired 80% of the stock of Foreign Corporation 2, its subsidiary, you went from an indirect ownership of 0 to an indirect ownership of 32%, which is certainly enough to trigger the filing threshold for categories 2 and 3. So that's an example there. Same idea with partnership at the top, except the difference is you have a 40% partnership interest, and the same math occurs, 32%. So in the year that the foreign partnership acquired the stock of the Foreign Corporation 3, its subsidiary entity, you went from owning no stock in Foreign Corporation 3 to owning 32%. That's clearly enough for Category 2 and Category 3 filing requirements. So here are the types of entities that are not flagged in the attribution rules in Section 6046 for calculating constructive or indirect ownership. First one is non-grantor trusts and foreign estates. So the rule is silent. And if it's silent, then the implication is if we didn't write a rule about it, you don't do it. Because the alternative would be to say, if we didn't write a rule about it, go look everywhere else in the code, and if you can find a rule that you think applies, apply that. Well, if you apply that kind of concept, silence means look everywhere else in Title 26, you would immediately go look at Section 318A, and you'd say, oh, look at that, and you'd find at Section 318A a conflicting set of rules compared to Section 6046. So Congress clearly intended with Section 6046 to say this is how you calculate indirect ownership, and so that's what we do. We don't go looking for supplemental information elsewhere in the code. Therefore, do not calculate indirect ownership through foreign non-grantor trusts or through foreign estates. The second set of entities that you might come across will be U.S. corporations and partnerships. And again, Section 6046 is silent for indirect ownership rules for these two entities. And the reason there, I think, is pretty simple. A U.S. corporation has its own 5471 filing requirement. So, if it acquires enough stock, it has its own Category 3 filing requirement. So you don't have to look to the U.S. corporation's shareholders, for instance. And at the bottom, I'm just giving you an example of sloppy jargon where constructive ownership is used when I think they really mean indirect ownership. But that's just to give you an example of how careful you need to be when you think about it and you apply these concepts and you are thinking through, do I have indirect ownership, do I have constructive ownership, or do I have actual ownership or direct ownership? Now here are three situations where these are not attribution rules. We're not saying we're going to pretend that you own the assets of another person. We are going to say this other person, this other tax-paying entity or non-tax-paying entity, as the case may be, is treated as if it just simply doesn't exist, and we're treating you as the direct owner, so your name on the stock certificate kind of situation. And the rules here, grantor trusts, as you might expect, disregarded entities, and for those what I do is treat the sole member of the disregarded entity as the direct owner of the foreign corporation stock, and we also flag a Form 8858 and sort of redundantly put the information there to make sure that it's reported because the 8858 has its own reporting requirement. Interestingly, nominees are called out in the regs for Section 6046 for Category 2 and Category 3 filing requirement. So ignore nominees and treat the actual owner, the principal, in the principal agent sort of situation, as the true owner of the stock and report it accordingly. All right, let's move on to category 4. And again, just a couple minutes of context. Who files this and why do they file it? And what's the government looking for? So a category 4 person is first, it's a U.S. person, so it could be human, could be an entity, that has control of a foreign corporation at any time during the tax year. There used to be this rule, 30 days and all that stuff. And at the moment, the rule is that you just had control at any moment in time in the tax year of the foreign corporation. The foreign corporation is not the same thing as a controlled foreign corporation, because a controlled foreign corporation, what you do is you look to identify the people who are U.S. shareholders, namely U.S. persons who own 10% or more of the stock, and then you take all of those people and you add their shareholdings together and you ask yourself, do they collectively own more than 50% of the stock of the foreign corporation? And that makes a controlled foreign corporation. What Category 4 is looking for is a person, a single taxpayer, who all alone owns more than 50% of the stock ownership of a foreign corporation. Now, you can look at this and you can say, well, duh, that obviously is going to make that person a U.S. shareholder, because that one person is going to own more than 10% of the stock of the foreign corporation. And duh, it's obviously a controlled foreign corporation. But the Category 4 is phrased in this way, and treat it this way, and don't jumble it up in your head. Just remember that we're just looking for a generic U.S. person, and we're looking at a generic foreign corporation, and we're looking at the more than 50% threshold for ownership. And the reason we're looking for ownership is because it's a proxy for control. And so if you look at the definition of control for Category 4, you see it's owns stock possessing more than 50% of the combined voting power of all the stocks issued and outstanding, or 50% of the value of all the classes of the stock issued and outstanding. And so what we're looking for is, if you own stock that's enough to be over the 50% threshold by voter value, then you are a Category 4 filer. And now let's flip back to the topic of this session, which is the attribution rules, which means what do you own? And we're going to now look at what does it mean to own stock indirectly or constructively. So you're a constructive owner of stock of a foreign corporation, therefore you own it for Category 4 purposes, or you are an indirect owner of stock of a foreign corporation, and therefore you own it for Category 4 computation purposes. And if the sum of all directly owned stock and indirectly owned stock and constructively owned stock exceeds 50% of the total issued and outstanding stock by voter value, then you have control of that foreign corporation. And here's where to find the law, and specifically the law for where do you find the attribution rules. The attribution rules, you figure out control, which is, as I said, a proxy for the word own or ownership, by using Section 318A, which is the default constructive ownership. Again, if you look at Section 318, the title of the code section is constructive ownership, when in fact what it's doing is stating a bunch of rules that state attribution rules by which you become an indirect shareholder or a constructive shareholder of foreign corporation stock. But anyway, I digress again to Grammarville. So you use Section 318 as your baseline, but there are two modifications, and we'll talk about the modifications as they come into play, one of which is downward attribution is prohibited. So the default rules in Section 318 allow downward attribution. I am a shareholder of Corporation B. I am a shareholder of Corporation A. In some situations, Corporation A will pretend that it owns my share of shares of stock of Corporation B. That's what downward attribution means. From shareholder to corporation in which the shareholder owns shares. The other one is just reducing a threshold for Section 318, where it sets a default 50% threshold for certain events happening for attribution, and it changes that to a much lower threshold of 10%. Again, let's start with family attribution. So the easiest way to see how things change dramatically from one set of attribution rules to the next is by comparing the little picture of the family attribution rules that you remember for categories 2 and 3 to the family attribution rules for category 4. So remember, for categories 2 and 3, grandparent, there was attribution from grandparent to little blue stick figure in the middle. There was attribution from sibling to little stick figure in the middle. So now sibling attribution no longer happens. So your sister can own 90% of the stock of a foreign corporation, and you are not treated as if you're the constructive ownership of that stock. Grandma can own 50% of the stock of Corporation B, the foreign corporation. You don't care because the constructive ownership rules for Category 4 will not attribute ownership of Grandma's stock to you. Again, there's no reattribution from one family member to another. So again, when I say reattribution, think of it like this. You've got directly owned stock, and you're going to bounce it by attribution to one person in the family. You do not bounce it a second time to another person in the family group for treating that second person as the constructive owner of the directly owned stock. And where the red line with the red circle with the line through it, whatever that's called for traffic signs, you can see that there's a generic rule in Section 318, 318A5B, that prohibits reattribution of constructively owned stock. It's the same rule, the same result, but said in a different place compared to categories 2 and 3, where that rule was hardwired into the regulations at Section 6046. Same result, though. So you don't bounce constructive ownership twice, just once. There's an interesting problem that you need to solve for Category 4 filers. And so let's just walk through a little example of how this works and how you think about it and how you solve it. You have Dad, who owns 100 shares of foreign corporation stock, and that's all the stock that's issued and outstanding. Mom is treated as the constructive owner of those 100 shares because spousal attribution. Child is also treated as the constructive owner of those 100 shares because parent-child attribution. So what do you have? You have a potential, if all three of these people are U.S. persons, to have 3 Category 4 filers, 3 people who are in control of foreign corporation. Dad, direct shareholder, and 2 constructive owners of the stock. And the constructive owners each are deemed to own 100% of the stock of the foreign corporation, constructively. Fortunately, the regulations of Section 318 have a solution for this. So, in applying Section 318A to determine the stock ownership for any person for any one purpose, so if you're looking at the family attribution rules of Section 318A, what do? So if you find a situation, just as we had in the previous slide, where an amount of stock owned by any one person, Dad, may be included in the computation more than one time, namely we've got constructive ownership going to Mom and to Kid, in that case, such stock shall only be included once, not to mom and kid, but to either mom or kid, in the manner which will impute to the person concerned, either mom or kid, the largest total stock ownership. In our example, both mom and kid would end up with 100 shares of stock. But in another example we could make up off the top of our head, let's pretend that mom owned 5 shares of stock already and kid owned none. In that case, if we attribute father's shares to mom, she ends up with 105. If we attribute father's shares to kid, he ends up with 100. Therefore, the attribution would go in favor of mom, and we would treat her as the constructive owner of dad's shares. So your quest is to look at this situation, and I gave you at the bottom a little script that I sort of talked through in my head, something like this. When I'm looking at a situation and trying to figure out how shall I attribute ownership amongst a family group and to whom for Category 4 purposes, I just do something like this, and I talk it through deliberately. And the way that I just read that little excerpt from the regulations and sort of added little editorial comments throughout it is the way that I actually do it in my head. And then once I've figured it out, of course, I write it down so I don't forget it, because otherwise I have to figure it out a second time. So here's what it looks like. And steps 1 through 8, we've sort of talked through all of these, and what do we do? The Category 4 filer, dad is for sure. Category 4 filer, mom and kid can be. Next, we decide that mom is going to be the one that we want, and then we have to decide, okay, what is mom going to do for compliance purposes? Making sure that there's no penalties imposed because you screwed something up, and what is kid going to do? And the answer to that is going to be that in my situation, I would probably do the attribution once in favor of mom, simply because it's easier to get mom's signature on a tax return than it is to get a kid's signature. And then we would use one of the filing exceptions, and I have a slide on that in the next slide, to reduce the paperwork load on mom so she doesn't have to do a full-bore Form 5471. And bullet point number 8 at the bottom on this slide is I'm probably going to wave a flag at the IRS, because I don't want the IRS to come back later and say, hey, according to the way we look at the constructive ownership rules, kid owns 100 shares and therefore is in control of this corporation. Why didn't you file a Form 5471 as a Category 4? And I want to head that off at the pass by a statement attached to the kid's tax return, and probably a statement attached to the 5471 as well. So, Category 4 filing exceptions. Go look at the instructions for Form 5471 to reduce the paperwork. There's a lot of stuff, and in a situation where dad's a U.S. person filing a Form 5471, it's going to be remarkably easy on mom. She's not going to have to duplicate the situation. For instance, that second bullet point, attribution is from a U.S. person who files Form 5471, namely dad. Then the constructive owner, namely mom, need not file Form 5471. But you're damn right, I'm going to put a statement on there saying that this is what we're doing and why. All right, let's move on from family attribution, which again, reminder, creates constructive ownership, to attribution from entities to owners, where we are now talking about indirect ownership. Indirect ownership, we're just looking at a classic stack of the parent subsidiary kind of structure, sometimes many, many tiers deep, but that's the classic idea to keep in your head. And it can work with multiple types of entities. And for the partnerships, estates, non-grantor trusts, and grantor trusts, the rules are very simple. It's the proportional ownership rule. Multiply your ownership stake in parent company by parent company's ownership stake in subsidiary, and that is your indirect ownership of the subsidiary stock for Category 4 filing purposes. The important one down here is going to be grantor trusts. You are the owner of whatever the grantor trust owns. So if you are the grantor of a grantor trust owns parent company stock, you are the direct owner of the parent company stock, and do the math from there. Now, I mentioned floors and floodgates before. This is where, in Category 4, we're going to see how this kind of thing works. So we're talking now, I'm going to use the example of a parent company and a subsidiary. And you need to understand and identify your stock position in the parent corporation, and then the parent company's stock ownership position for the subsidiary. Let's look first at the floor. So if your shareholdings in parent corporation are less than 10%, then there will be no attribution of subsidiary stock to you. So below 10%, don't worry about subsidiary. Don't worry about whether you need to include any stock for purposes of calculating, do I have control of subsidiary or not? If you own 10% or more, up to 50%, then the calculation is going to be the simple pro rata X% times Y% thing that we've done before. You take your stock ownership of parent corporation multiplied by the parent corporation's stock ownership of subsidiary, and that is your indirect ownership interest in subsidiary stock. When your ownership of parent corporation stock exceeds 50%, then we're hitting this floodgate situation. And the floodgate situation happens only when you own more than 50% of the stock of parent company, and parent company owns more than 50% of the stock of subsidiary. In that case, you have automatic control. You don't even have to do the math. You just have it. And I've given you the citation there from the code for that purposes. Below, if the parent company owns less than 50% of subsidiary stock, then again you have that pro rata multiplication game. Your stock position in parent company multiplied by parent company's stock position in subsidiary equals how many shares of stock you are deemed to indirectly own of subsidiary stock. So the important thing there is this transitive calculation, like a math property, where the control of parent company and parent company controls subsidiary means automatically you control the subsidiary. And here it is in a beautiful little picture. You are blue stick figure as usual. You own more than 60% of parent company, CFC1, so you control CFC1. CFC1, the parent company, owns 60% of CFC2, the subsidiary. Again, CFC1 controls CFC2 because CFC1 owns more than 50% of CFC2, and therefore you are deemed to control CFC2, and you are a Category 4 filer for CFC2. And I've given you the citation to the regs over there on the right, and you note that this is an override of that simple math calculation, because if you do 60% times 60%, that equals 36%, and 36% is not greater than 50%, so according to simple math, you would not control it, but because this regulation exists, you do control subsidiary, CFC2 in the picture. So that was upward attribution. So in other words, we were attributing parent company's ownership of subsidiary stock and pretending that you are the indirect owner of that subsidiary stock. But now let's look at it the other way, where you are sitting there owning stock in various corporations, and we are attributing ownership of various stock that you own to each of the companies in which you own stock. The first critical thing here is to note there is no downward attribution from a foreign person. So this will, when we talk about category 5, categories 1 and 5, we will talk about the repeal of section 958B4, where this rule, no downward attribution from a foreign person, existed for category 5. And it went away at the end of 2017. But it has always existed and still exists for category 4 purposes. So now here we have attribution to partnerships, estates, and trusts, and there's no threshold in here. Remember, we talked about floors and floodgates before. Here there's no threshold. If you are a partner in a partnership, we pretend that the partnership owns the stock that you own in various corporations. If you are a beneficiary of an estate, then the estates are the constructive owners of what you own. Non-grantor trusts and grantor trusts, same set of things. We're just going to pretend that the entity below you owns the stock that you own. For corporations, however, there is a threshold below which we're not going to do downward attribution, above which we are. And here, I'm pausing because I don't know how to say it exactly right, because I get confused on this point every time. But you see an exact 50% ownership of stock here matters for the threshold, whereas category 4 generally, it's a more than 50% threshold for control. And I can't tell you how much this thing bugs me, the exact 50%, and I can't tell you all the different places in tax law where you have to look again and again. Does it say more than X percent, or exactly 50% or more? So this is a 50% or more will create downward attribution, and less than 50% will not. Again, all I can tell you is you have to read the regulations and get this right, and really look for this 50% or more than 50% language again and again. So here we have a situation, just to talk it through briefly, where you, blue stick figure, own stock of Corporation A and own stock of Corporation B. On the left, you own at least 50%, but up to 100% of Corporation A. In that case, Corporation A must pretend that it owns the stock of Corporation B. By contrast, on the right, the little example there, you own less than 50% of Corporation A stock. Therefore, Corporation A does not pretend that it is the constructive owner of Corporation B stock. Finally, let's wrap up with categories 1 and 5. First, let's talk about family attribution. And let's compare category 1 and 5. I put 5 here, but it's 1 and 5 both. They're exactly the same as category 4 because they both start with the common ingredient, namely Section 318A attribution rules. But for category 5 and category 1 purposes, attribution from a non-resident alien is not allowed explicitly. So again, this is just one of these situations with Form 5471 where you have to move carefully and make sure that you're reading things exactly right and not relying on your memory. Like, oh, I know how this works. I've done this 100 times. Well, 101st time, you'll forget this because ask me how I know that this happens. The brain is an excellent forgetter. Family attribution. The family attribution for categories 1 and 5 looks exactly like it does for category 4, which is not surprising because it starts from the Section 318 family attribution rules. The only critical difference here is that unlike category 4, where attribution from a non-resident alien is allowed, for categories 1 and 5, non-resident alien attribution to you, blue stick figure in the middle, is not allowed. And again, for categories 1 and 5, look who is not part of the equation for attributing stock ownership to you. Siblings, off limits. Grandparents, off limits. And again, we saw for category 4 that reattribution of directly owned stock is not allowed. And the same rule applies because, again, we're starting from the same baseline, namely the attribution rules of Section 318. And so that 318A5, no reattribution prohibition, will apply for categories 1 and 5, just as it did for category 4. So now let's talk about attribution from entities to their owners. So having done the families, let's talk about indirect ownership. We're talking about upward attribution, so we're talking about in the context of a corporation. Parent company owns stock of subsidiary. You are a shareholder of parent company. How much stock do we pretend that you own indirectly of subsidiary? Here, for categories 1 and 5, for determining your position as a stockholder in the foreign corporation, we have one of these trigger points, a floodgate. So again, on the left column, you have a certain percentage ownership in one of these entities, partnership, estate, non-grantor trust. And the entity owns Y%, that's the middle column, of foreign corporation stock. And on the right, the math, what are your attributed ownership, indirect ownership, of the foreign corporation stock. And the little equation there shows you how to do it and tells you why to do it. The red or pink or whatever color it is, salmon, rows here show you what happens when this entity owns more than 50%. So it's not 50% or more, it's more than 50% of the stock of a foreign corporation. At that point, you just use your ownership interest in the entity multiplied by 100%. And this is true for partnerships, estates, and non-grantor trusts. And that's the impact of Section 958B2, which is one of the overrides in Section 958 to the default attribution rules of Section 318. Similarly, for a grantor trust, since you are the direct owner of everything in the grantor trust, it's going to end up being 100% times 100%. So that's what you're going to be treated as the owner of. Upward attribution from corporation to shareholder. So now we've gone from the partnerships, estates, and trusts over to the corporations. And again, we have this threshold of below 10%, we don't care. So the top row below the heading, you own less than 10% of parent company, and parent company owns Y% of subsidiary. Your attributed ownership of the subsidiary company stock is 0 because you're below the 10% ownership of parent company. So even if parent company owned 100% of subsidiary, you would not be attributed any indirect ownership of subsidiary company stock. Then, if you own 10% or more, the decision point has to come we have to look at the ownership of parent company's stock position in subsidiary. Does it own up to and including 50%, or does it own more than 50%? And if it owns more than 50%, it's that 100% toggle. So you just take your stock ownership position in parent company stock times 100%, and that's your indirect ownership of subsidiary stock. Finally, let's look at downward attribution. So downward attribution, remember we talked about this in category 4, it's when the shareholders' assets, stock in various corporations, are treated as if they are owned, the shareholders' assets are owned by the entities that the individual shareholder holds positions in. Partnerships, estates, non-grantor trusts, and grantor trusts, it's just attributed down. There's no threshold, well, except for the non-grantor trust, where they don't care about you if you are a beneficiary and your actuarially computed beneficial interest in the trust is 5% or below. So you will just pass that share ownership down to the entity, and the entity will be deemed to own that stock for calculation of purposes of, what does it have for category 1 and category 5. But this slide here, the little picture, I wanted to give the simple example to show how the elimination of section 958B4, which was the rule that said you don't attribute from non-residents in such a way as to make a U.S. person a shareholder of foreign-owned stock, that change at the end of 2017 created a bunch of accidental controlled foreign corporations and a bunch of accidental U.S. shareholders that have Form 5471 filing requirements. So here's an example. We have a foreign parent company, and parent company owns 2 subsidiaries. Subsidiary A is a U.S. corporation. Subsidiary B is a foreign corporation. And they're doing, presumably U.S. corporation doing business in the United States, and foreign corporation is doing business in some other company. As long as parent company owns 50% or more of the U.S. subsidiary, downward attribution occurs because of the default rule in Section 318A3C. And the effect of this, in my little example, is to treat subsidiary A, the U.S. corporation, as if it is the 100% shareholder of subsidiary B, the foreign corporation. So whereas before the law change at the end of 2017, subsidiary A would never have a 5471 filing requirement for subsidiary B, now it does. And we have created subsidiary B as a controlled foreign corporation. So this is the situation that comes into play, and this is why really understanding the ownership positions and the shareholdings and the relationship between the shareholders, and if they're family members, who are they? Are they non-resident aliens? Are they resident aliens? And what relationship they are to each other is so critical in deciding what category box are you going to check and what information are you going to provide here, because without clear understanding of the facts, you're not going to be able to do the attribution calculations correctly and figure out what to do with the person's tax return. Well, with that, we come to the conclusion, and this is the hand-wavy thing, and all I can tell you is from experience, I find that an actual picture, a diagram of the ownership structure for a corporation is essential to my thinking. You label it carefully by names of people, by number of shares owned. I don't like to put percentages. I like actual numbers of shares because, quite frankly, I find out that people think that the shareholdings in corporations are one thing, but the corporation's records usually match up, but sometimes they don't, and sometimes fatally. Oh, we thought that my kid owned 25% of the stock, but we forgot to issue stock to the person, and so I'm actually the 100% owner and always have been. Things like this happen. Paperwork failures. Label everything: people, names, countries of formation of the entities, if it's an entity, countries of citizenship and residence, both for humans, names of persons, relationship of the person to any of the other people in the picture, brother, sister, cousin, uncle, whatever, unrelated friend. Just so you know, and then you can start to annotate that diagram, and you can understand, and you can stick it in the file, and you'll always know that you've done the Form 5471 calculations for how many shares does my client own correctly for constructive ownership, for indirect ownership. That, to my mind, is the key, and this is the takeaway I give to you. And good luck, and we will see you next time.